Welcome back. You're tuned into Bazaar Morning Call. As promised, let's get straight to the first management. We have CSB Bank. They reported a decent set of numbers. The deposits came in healthy. The NIMs fell sharply. To understand what's the way ahead, Mr. Mondal, the MD and CEO at CSB Bank, joins us on the show. Hi, Mr. Mondal. Good morning and always good to see you win. Give us a couple of details. Your cost of funds, I think, were hovering around 7%. Your NIMs have seen some kind of contraction. What's the outlook on both these two parameters going ahead?
Good morning, Nigel, and good morning to your viewers. We had a decent quarter, as you said rightly. Having said that, there has been a little bit of a challenge in the NIM, primarily because of two reasons. One is we had taken a conscious call to reduce or degrow our high-yielding businesses like MFI, personal loans, agri, those kind of businesses, which effectively meant that we are mostly focused on our wholesale, retail, MSME, and gold. The second part is also on the wholesale side. As I said before, that we are exiting some of the larger but high-yielding relationships, which we did last quarter. And that's one of the reasons why our wholesale business is looking little muted, though we have grown there on the core book by 30%, but we have shown a 4% growth because of some of the exits we did. And thirdly, of course, the cost of funds, which everybody is facing in the industry right now, has gone up. And will continue for a while till the liquidity issue is sorted out. So I think broadly, based on all these, there had been a little bit of a pressure on the NIMs. I'm not expecting it to really pressure to calm down. So we have to wait and watch how this quarter plays out. On our cost of funds, I think it's also a function of cost of deposits, CASA, and some of the FCI borrowings, which we took to ensure our LCR ratios are much better. We ended the quarter 130% on a period end basis and average 119% on the LCR side. So FCI borrowing would have taken up the cost slightly more than what it was normal, but with SOFR, because it's SOFR linked, it will start coming down once the SOFR starts coming down. So broadly, we are okay because overall ROA we have managed at 1.52%. And broadly, I think we are chugging along well in our overall plans, what we plan for SBS 2030.
But sir, you're guiding that in Q4, NIMs decline even further compared to Q3 levels? And what percentage of your book comes from those high-yielding assets, like credit cards and MFIs? And what's the extent of pruning of the portfolio and how much more to go?
So currently, Reema, good morning. Currently, we have around 4%, well, less than 5%, actually 4.2% of our book is unsecured, which would include some of these products and businesses which you're talking of. So we have pruned it quite a bit, and we are not growing them anymore. So we have only 3 businesses we have degrown this quarter, which are these products. And going ahead, yes, I think our NIM, we have to wait and watch this quarter, depending on how the cost of funds is and how the cost of deposits are going up. In my last interview, when I said 7% is our cost of funds, I said incremental cost of funds is around 7%. Overall, our cost of funds is closer to 6.4. Having said that, we expect the pressure to be on, though RBI is taking a lot of steps to ensure there is more liquidity in the markets. But we have to wait and watch how it works out. But I'm not expecting NIM to go up from here anymore. We have to manage within I think now the range will be between 4 to 4.2. In that range, you have to play.
All right, Mr. Mondal, what about asset quality? If you could give us some numbers, slippages, how you see the book shape up going ahead. Because the fear is that, not just for your bank, for the industry on the whole, there could be signs of pain. What's your take?
Yeah, Nigel, I mean, fortunately for us, we saw some of this coming. I think it's a small cycle, not a big one, but still we are a small bank, so we have to be careful. So on the MFI, personal loans, unsecured loans, agri, all these businesses, we actually have degrown this quarter product by product. Even last quarter, we had degrown. So from that perspective, it's only 4% of our book at this point of time. Overall, our GNP has come down by around 10 basis points. And NNP has come down by 5 basis points compared to what it was last quarter. But on a year-on basis, there is a slight elevation. But overall, I think with a credit cost of below 20 basis points, we are pretty much okay. And I am not seeing any reasons why our credit cost should go up in this year. So I think we're pretty much safe and doing whatever we can do in terms of quality of book. And that's the reason we actually exited a lot of relationships with higher yields. And we are playing in the range between 8% to 12% range in terms of IRR for all our businesses, including gold and wholesale and SME and retail. So I think our credit quality is pretty good at this point of time.
Your gross NPAs were at 1.58%. Do you think you can bring it down to 1.5% as exit gross NPAs and these advances deposits growth of 25-30%? Is that sustainable in Q4 or at least the first half of FY26?
I think on the growth side, we should not have too much of an issue. I mean, my guidance had been that we will grow 30% to 50% faster than the system. That has been my consistent guidance over the last 2-3 years. This quarter, we have done a little better. We have grown faster than the system by almost 100%. And I think that's because the system slowed down. We continue to do whatever we are doing, maybe a little better. But overall, I think we should be able to maintain this kind of a growth for us in the next quarter or in foreseeable future. I don't see a problem. And in terms of credit cost, I see it retaining at these levels. But slightly in the long run, we may come down also on the GNP and NNPA because we had a slippage at the beginning of this year, which will carry through this year. And once we start provisioning them fully, hopefully the overall NPA will start showing little decline. But that's somewhere will happen in the next year. At this point of time, I would hold on to these numbers where we are right now.
All right, Pralay, good to speak with you. Thank you very much for joining us as always here on CNBC TV18. And we'll, of course, come back and circle around, speak with you more over the next couple of months.